M&A Mississauga chapter presentation for 2022. So thank you for an amazing year of great presentations. We're lucky enough to have two in person, this being the second one. And next year, we're going to continue on with the hybrid model of having our meetings in person and online. We will be changing them back to the original format for our group, which was breakfast meetings. Just that we find that given the location, it's a little bit easier for people to come here during the mornings and then have the rest of the day to continue on with their work. So thank you again for a great year. Just a couple of points about the M&A Club. We have 19 chapters at this point. The Mississauga chapter has been now, I think we're entering our fourth year. So, a great few years with some great partnerships and a lot of great networking and deal flow that's come out through the people that have been attending. And so obviously we encourage you to do that. In the club, like I said, 19 chapters across the country. Bram will usually give a little more on the club itself, but basically as a member, you get access to all 19 clubs, the membership benefits and a couple of other key benefits as being a member. So definitely something to inquire about. Getting access to these meetings is super important. Just again, for a lot of folks that have been here and done this in person, it's great to have the online because you get the learning, but the in-person networking and meeting the folks in the room is really where the other side of the benefit is, and being able to create some deal flow, which I know for a lot of us that have been doing that, it's been a huge part of our success factor. So before we continue forward, I'm going to bring up Chris from Loops or Nixon. We're actually in their beautiful office over here, so he'll give you a little bit about the law firm here and some background on that. So Chris, you want to make your way up and share a little bit about Loopstra?
Thanks a lot for the kind introduction. I just want to say thanks to everyone who's joining online. Regrettably, you couldn't join physically today, but maybe next time for sure. Everyone who's here physically, thanks again. Hopefully you're enjoying the food and the refreshments. Just a little bit about our firm. We are a full service business law firm. So basically, our business model is we are a one-stop shop for any business's legal needs. You come here, you need employment, corporate commercial, litigation, real estate, zoning and planning, what have you, we can take care of it. I'm in the corporate commercial group. I'm an associate with Derek Van Doren. Derek regrettably couldn't make it here today, but I think he might be joining online. But at any rate, I know that he's an active member and he sends his regrets. But I will wrap this up by saying that we're really thrilled to have you all here today, and looking forward to making some connections and hopefully some further synergies can happen between all our different businesses. So enjoy.
Thanks, Chris. So between Derek and myself, we co-chair the Mississauga chapter. I'm with National Bank in the mid-market commercial. We work on all sorts of amazing M&A transactions and general commercial transactions. We actually work quite closely with Chris and Derek and their team on multiple transactions. So great firm to work with. Cash flow financing in our team goes up to about 10 million. With our national accounts partners, 10 million and above. So, again, we can manage transactions across the board. All right, so just a quick introduction to our speakers for this afternoon. So Transition Architects is a full service M&A advisory sale firm focused on small to medium sized privately owned businesses. Our two speakers are April and Ross. April has a lengthy career in banking, founded Transition Architects after a couple of short engagements with different brokerage firms. And then Ross has a 25-year experience in commercial banking, holding positions as VP of commercial banking and supported private equity and ABL groups, primarily within the Scotiabank, if I have that correct. And in 2015, became the CIO of Miller Group, which became White Owl Family Offices, and obviously now you're with Transition Architects. Had a conversation and got to see a glimpse into this presentation earlier on with April. So the really cool thing about this is we've all sort of, even in the room prior to starting this meeting, we've all had a couple of discussions about what we've seen over the last couple of years. The really cool thing about this presentation is it talks about the qualitative side of that, but also quantifies some of the numbers on some of those trends that we saw. So really interesting stats and information from Transition Architects. So I'm going to get out of their way, let them come up here and share all that great information with you. So ladies and gentlemen, just please give a round of applause if you're in the room to April and Ross.
Thanks, everyone. And thank you very much for inviting us to present today. We appreciate the opportunity to share with you some of our thoughts on what's happening in the market and things that we can do to, respond accordingly to the changes. So if you want to just flip this slide. So what is Transition Architects? I like to start with that because it's the name of the company, but it also really highlights what we're trying to accomplish. Like I said earlier, I had spent time at a couple of brokerage firms after a long career in commercial banking as well. I was with Scotiabank for many years, and then felt that the small, medium-sized market wasn't fully serviced and needed some help to understand transition options. So there's where the name Transition Architects is coming from. Understand that that's a challenging market. The SME market tends to be a little more difficult because they haven't got full-time financial support, strategic support. The planning isn't as good, and we're trying to help with that. And so we spend a lot of time upfront with our clients, assessing the situation, helping them prep, staging their companies, but also understanding market dynamics, and so that we are in a position to respond properly to what the market's going to offer them. Next slide. So we've been pretty successful, like really only been operating for 2 years specifically as Transition Architects. Like I said, we did a number of deals with other groups before, but finding that our solutions are a little more creative, taking a longer term approach to doing deals, not rushing to the transaction, but making sure that organizationally it's structured properly, numbers make sense, backup is in place, that kind of thing before they go to market. The clients like it, the buyers like it too. So I'm certainly, I just threw a couple of testimonials on here, but we work so closely with the buyers that, often the sellers are wondering who we're working for at some point, because we're really trying to find a way to get the deal done and not just, push one side of the transaction through. Next slide. So I'm just going to talk a little bit about me, how we got here, and then Ross is going to do the market update. And then after that, I will kind of close and talk about closing the gap, how we maybe can look at some different deal structures that can respond to the situations that we're having to deal with today. So some of this I'm repeating. I've said, I was in banking, commercial banking, technology, did some data governance work with Scotia, left Scotia, did some work with Canadian Western Bank. And I did find, it was very interesting. I got to learn granular kind of work and then moving up to more of an aggregate level. At one point, I was part of the team running a database doing regulatory reporting for Scotiabank. So it was a very interesting view of the world from, your bite sizes of information to rolling up how that aggregates. Fascinating, but also highly political. Felt that it wasn't as rewarding to me. So part of what happened is when I left the bank, I kind of went, where do I feel I can really contribute at this point in my career? I'm contributing based on a lengthy experience, a lot of interesting knowledge that not everybody has. And I came to the point that I wanted to be working with clients more directly. And I really felt that the small business was underrepresented. Small meaning kind of under 20 million. So everybody defines that differently. 20 million in sales. Certainly, Ross and I have a breadth of experience and quite capable dealing with larger deals, but we felt that this market was underserviced, and it's turning out that way. Like we're getting referrals from the other M&A shops now because they're just saying, I don't want to deal with the small ones. But with my background in process and efficiencies, we're able to offer, a solution that fits the needs and the size of the client as well. So we're obviously, the smaller deals, we're doing a certain amount of work and we're expanding that for the more complicated deals. I started with different brokerage firm, a couple of them. I just felt that I was wired differently, a little more value add, relationship driven. I do find that approach was working really well in this market. It's complicated, tends to be highly emotional. the sellers are very, very attached to their business, and you have to spend a lot of time kind of coaching them at the beginning so that we can align their expectations with market realities. So that's why I left and started on my own. And our motto really is helping businesses thrive through transition, looking at taking a couple years to put that transition strategy in place before we go to market. Generally, sometimes it's quicker, sometimes it's longer, but then we have a successful offering when we take it to market. And certainly our close rate is much, much, much higher because of that. And, you know, it seems to be working. So on that, I'm going to let Ross get into the market update. He's been working hard, gathering information, and seriously, it's changing by the day. So we only finished this last night. So go ahead, Ross.
Hello, everybody. I'm Ross Jones. Quick intro. So I owned a business and I sold it back in '89, and it was the most frustrating thing I ever did in my life. Then I joined the bank and I did a lot of senior debt for many years. A lot of it was acquisition financing. I worked through the lower end of the mid-market to the, you know, the higher end of the market, and ended up being a VP and ran a York Commercial Banking Center for a bit. And then I stayed on to run the deals over 20 million. I also did some ABL stuff, which was a lot of acquisitions. And while we were downtown in the ABL group, I supported the private equity coverage group of Scotia. So I saw hundreds of deals. And as even as April, we saw many deals in many different industries, and we're 3 feet deep and 12 miles wide. We've seen a little bit of every kind of company. So I got poached out of there to go into the Miller Group, start up a family office, diversify funds outside the core business, started buying businesses, putting checks in around $5, $7, $10 million. And then they sold the main asset, which was Miller Paving, and we rebranded as White Owl Family Office. So I did that for about 7 years. And, you know, over the whole period, I was always the cheerleader for the entrepreneur. I was buying the entrepreneur's business. I was getting them to stay in for a few years. And as such, I had an intimate relationship with a lot of entrepreneurs. I got it, and I really enjoyed that space. Change the slide. So what I'm going to do is the first few slides are really, quite frankly, a quick and dirty update for some people who haven't read all the publications out there, and I have maybe a little bit of a spin, but basically, you know, what we're looking at is good times across the board. Private equity got $3 billion to spend. Most private equity guys got platforms. They're folding companies into platforms quickly, aggressively. And if you look at historical 2018, 2020 were great years. They were years that nobody expected us to ever beat. And they just kind of looked like it just kept coming. And in 2021, we actually overheated. The lawyers, the accountants, the due diligence guys didn't have enough capacity to look after how many deals were getting done. So 2021 was a record year across the board, and you had to expect that somehow the overheating was going to simmer down, which you started to see that. In 2021, I think some deals didn't get done, and my personal opinion, they spilled over into Q1 and Q2 of this year. And then we're starting to see, we're sliding down a hill a little bit. And it's a slippery slope, and we're not really sure how far we're going to go down. But right now, over that period of time, you know, most M&A guys were overpricing their deal, getting multiple LOIs, getting people to sharpen their pencil for even a better deal. And it was a seller's market, definitely. Next slide. So here's just a quick and dirty. You know, you see the trend line coming down there. And if you look at the numbers, the number one is kind of like the global numbers, which says we're dropped about 12% year over year to Q1 versus Q1 the previous year. And we've dropped 19% from Q1 2020 to 2021. 19% is a pretty good drop. So the real question is, we're coming down the slope and we're not sure where we're going. And whoever can answer where we're going, I'd really like to talk to them, because there's very different opinions out there. Anyways, next slide, please. So that's kind of where we're at. You know, just a quick and dirty. I mean, the interest rates are going nuts on us here. Inflation, yeah, food, gas, and all that's going up. But wages are also going up. Maybe a little slower, but there is some relief going on. But all this is driving inflation, obviously. And, you know, the government's got to push up the interest rates to level off inflation. We don't have a lot of choice in this matter. And this is kind of beyond our control. The government's going to control this, whether we like it or not. And in many cases, the US government's going to control it. We got people experiencing HR problems. When I was running my assets, we asked people to come back 3 days a week and 12% resign within the month. I remember the one guy who was a director in the IT area. He moved to Sarnia. I'm like, okay, so how does this work? You work every day in the office. Well, not anymore. You can take me or leave me. I moved to Sarnia. I sold my house in Toronto for a fortune. And I spent 1/3 the amount and bought a house in Sarnia. So you had stuff like that going on that nobody had ever seen before. Look at the rents. The rents have gone nuts. You know, I was talking to a couple of you guys from Roynet, and the value of buildings in the last couple of years are like doubled. I mean, nobody's ever seen anything like this in our life. So we're in a pretty bizarre situation, overheating across the board. And what I see is, I see a situation here where everybody's talking about a recession, and there's a pretty good argument we could probably use one, because things have got overheated and got a little out of hand. I mean, if I was selling a business, I wouldn't be thinking that way, but that's the reality. Next slide, please. So on the headwind side, everybody's got a different opinion. Economists say one thing, guys from the M&A shop say something else. Every salesman at the ACG conference in last week said everything's wonderful, and every credit guy said, you know, we're getting worried. So I don't know what they're doing back at their own office. I guess there's a lot of arm wrestles going on, but you know, that's not my problem. But what we're seeing is that the government's going to control interest rates and keep jamming them up until inflation subsides. And we don't know whether they're going to be capable of creating a soft landing or not. It's really, you know, I don't know. I'm no economist. So we are overheated. We're decelerating. And really the question is, how much do we actually decelerate? If you're selling a company, the market's great. If you're buying the company, there's risk everywhere and uncertainty. So really what we're saying is the gap between the buyer and the seller seems to be widening. And it's going to be interesting to see how we either fill the gap or we don't get the deal done. Next slide. I think, you know, because I'm a banker, I'm a little biased. I think the banks will drive some of this process. I think they will be a big part of this. If the banks, you know, look at all the M&A models, I don't know how many people look closely at the buy model that most of the private equity groups use. But the second you take the interest rate on the term debt up 2 or 3%, and the bank all of a sudden won't give you 375 EBITDA, they'll only give you 3.25. Literally your returns go from 25% to 10. And are you going to do that deal? Probably not. So everybody's going to be pushing back, I think, on the price, or they're going to be finding some way to fill the gap between where they think they should be and where the seller wants to be. I do think there'll be, I'm a little biased with the family offices. So I do think the family offices will not be as aggressive on reducing the pricing, because a lot of them are using their own equity. A lot of them don't use a lot of bank debt. So they don't see that in their model at the same way as the private equity guys. They're not levering up the same amount. So I see the family office guys are still going to hang around. And I do think that the synergy guys that are looking to buy and they got cash on their balance sheet, you know, it's still only making 2 or 3% interest. I think they're still interested. I think the other thing that's kind of interesting coming is the wave of alternative lenders. I saw some of them on the list of people that are actually attending in the audience. And, you know, this is a new wave. This is interesting, because they're going to take the deals when they get into a little trouble with the bank, and they're just going to scoop them up and redo them through their book. Or else, you know, we're going to see how aggressive they get on M&A. They might step up here and start doing M&A deals that the senior debt, you know, the chartered A banks don't do. So this is in uncharted waters, I'd say. And then I would just say that, you know, when I was at the ACG, there was actually one chartered A bank that actually was asking some of their account managers to move out of the main marketing side into the special loans group. So some of them are battening down the hatches and expecting, not sure what's coming. Next slide. The private equity side, I think the first point is probably the most relevant, and that is that most private equity guys got a couple of managing directors that have been around for 15, 20 years. And the one thing they all remember is the year after a recession, they had the best ROIs of the portfolio's career or history. So are you going to buy now and take a chance, or are you going to hope that things slide down over the next 6 to 12 months? If we have a little bit of a recession, price comes down, you got lots of dry powder, and you'll be in there buying hard. And I think that's what some of them are thinking. And, you know, there's no doubt about it. If you look at the charts, the returns were significantly higher 12 to 18 months after recession. So I don't want too many people to realize that. And I think the second thing is that some of the PE guys only have so much horsepower. They only have so many employees. And when they got guys dealing with companies coming out of COVID, and they got guys with supply problems, and they got investments with all these issues, they kind of turned inward instead of out marketing. And, you know, when you got to go to work, I mean, I lived this when I was at the commercial bank. When you get to work and you got to deal with 2 shitty files in the morning, and you have lunch, and then you go out and see a new business deal, you kind of lose a little bit of your excitement of doing a new business, or you kind of are less aggressive in how we think, right? Uh-oh.
Sorry.
Everything okay?
Yeah, no.
Okay, so I do think that they're deploying the resources a little differently. Next slide. Oh, I don't know what's going on here. I'm not touching anything. So the summary of what I think's going on is massive uncertainty. My advice to the M&A advisors on the line is, if I had a company that was ready to sell, I'd sell it as soon as humanly possible, because I think it's going down in value every day. So not sure where it's going to bottom out, but that's my personal opinion. I'm sure there's lots of people on the line that like to challenge me on that, but that's what I'm seeing. I think the peak enterprise value is gone. And I think it's important for all of us, you know, stay close to private equity guys, stay close to the banks, so that you know when they move, because when they move, they're going to move fast. I mean, I worked at the bank, and when it came down from the top, it came down as an axe. I shall know no leverage deals over 3.25 times EBITDA. It was a very blunt conversation. So if you were in the know, you'd see if the leverage comes down on the senior debt side, you can't help but see the enterprise value dropping. You know, if we lose half a turn on the senior debt side, we're going to lose at least half a turn on the EBITDA multiple that drives into the enterprise value. That's my opinion. Just some quick things, as I sat in front of about 200 people in the last week at the ACG. I spoke to a lot of the senior guys at different banks, and they say, we're open, but we're kind of not sure. Our appetite is kind of wobbling right now, and we're kind of waiting for signals from above. And they're asking more questions on new deals. One comment I'd make if I was an advisor is I would go and take some of the businesses that you're advising and go tell them to get more credit facilities now. It's much easier to get an increase in credit now than in 4 months or 6 months or whatever when you're sitting in a recession. It's a different game. So go get lots of liquidity so you don't have to worry about it. And I guess a couple of quick things that I noticed, even just monitoring some of the friends and people that I have in the industry, there is people now saying, hey, I got deals to sell and I got no buyers. It is happening. There is people saying, hey, you know what? I had a 2 or 3% EBITDA growth curve in all my projections, and the company's having a shitty year. And how do I sell this to a buyer with this 3% EBITDA growth when their EBITDA is down 3%? So there's a little bit of an issue going on the interim numbers right now. And I think the buyers will be cautious. So that's just our opinion. And I'm sure, as I said earlier, everybody has a different opinion right now. If you got 5 deals in market, you think the market's great. If you got, looking at buying 2 or 3 deals, you think the markets are turning into a tough market. And it's all about the gap. That's all I got to say. It's up to you.
Is there any questions? Like, I'm gonna provide a little bit of how to close the gap, but do we have any questions yet?
Well, if they come up on the screen.
Okay. Okay.
There might be something, there's a Q&A in here. So we'll get.
There's only one. You want to do it at the end? Okay, or you want to do it now?
Lorraine, if you want to just pull up that question in the Q&A, we can address that one now before we move on to the next section.
I hope it's about my ex-boss.
You want me to read the question?
Yes, the Q&A, yeah. The one question
Okay,
that's in
so
there.
we received one question. Do you see any impact in the M&A evaluation due to ESG in addition to the foreseen uncertainty?
On the lower end, it's not as big of an issue. The big corporates have addressed this concern and are reacting and are deploying resources at it. But when you got a firm with 15 people working there and you're making widgets, I don't see much of an impact from that. I kind of wish there was, but April, maybe you think differently, but I don't really see that.
Yeah. Okay, so we can move to the next section. Is pardon me? He tends to be a little chattier than me, so I made him put a timer on because I'm a little more brief.
I'm staying till 5 tonight.
Anyhow, after hearing that, clearly, it's a tough time, and it's very uncertain. And what does that do? I mean, that tends up driving this big gap. So our initial presentation was to be called emerging structures or something like that. And essentially that's what we're going to talk about, but it's about closing the gap too. So how do we start aligning what buyers want to pay with what sellers expect to pay, right? So, and we're just giving some thoughts, some of the things we've done, some of the things that we think could work in this environment. And then, we'd love some insight too at the end of it, because you might have other ideas that we don't have. So we see the gap widening. So sellers tend to be, not quite as up to date with what's happening. They feel it, but they're not looking at financial models all day long. So, and a lot of them thought that, once COVID was done, everything would bounce back and they could start returning to price points that, pre-COVID. And, certainly we're working through all that with our analysis, but shutdowns, okay, that's over, but now we got new problems, right? And so it's getting really hard to unwind this multitude of issues on top. So it wasn't just shutdowns, it's not just staff shortages, then we have supply chain challenges. You want to adjust your EBITDA and make it, say that was an exceptional situation, that's not going to happen again. People aren't going to pay, what was it? I heard about freight costs. What used to be $1,500 a container, and it went to $15,000 a container last year, right? So typically I would approach my analysis taking that off and saying that was a one-time blip, but you know what? It's still not down to 15 anymore. It's something else, and it changes by the minute. So the complexity is hard to quantify. It's hard for the buyers to get comfortable because who knows what's coming out of the next corner. So, in addition, the banks are taking a really, really hard look at EBITDA, and everyone's discounting it. Like everyone's discounting it. So, we've done a couple deals, basically just carve out, 20% of the EBITDA because there was COVID subsidies. You've probably all seen that now, but, we all thought that like keeping those staff on, keeping them working and paying them was a good thing. Well, so now they just got, it's hit their EBITDA line twice because they've still paid for the staff and they're not getting credit for the subsidies. So all of that is driving down, valuations, which impacts bank financing and everything else. And the banks, like Ross had said is, certainly they're more cautious. We're seeing that, the 1.5 to 1 turn EBITDA. So they're reducing the funding. The buyers are struggling with market uncertainty, recession concerns. Certainly, ROIs are coming down because of the cost of capital's going up. Can they get their banking? And then just retrenching with what they're holding, already. So trying to just keep them afloat. Next slide. So trying to find ways to close the gap on that. So what we're finding again, and what I say small business, but it's like typically we're looking at under 20 million. So, but I think it's really, really important that you spend a lot of time with your sellers, helping them understand what's going on. And that's certainly what we're doing. Like we're putting a lot more time into that upfront assessment. We're spending a lot of time educating them, and we're trying to get them to understand what's going on in the real world. So level setting expectations, helping them realize that, like we're saying, sellers are driving up. And if you get a seller, if you've got somebody who's got some energy and a bit of money, then let's find a way to close the gap between what they're comfortable with and what you're expecting. So next slide. So apart from getting everybody on the same page, then certainly we can look at trying to mitigate buyer risk through a variety of ways. Certainly trying to keep the sellers engaged for a longer period, which is again, back to transition planning versus doing a deal and getting out. It's going to be a longer term. So I think that's probably going to be the key of the conversation is it's going to take longer to get out now when you're selling. So, and especially in this market, takes a couple of years, either from an operational standpoint where you're involved or a financial standpoint where you're providing passive capital, passive equity for the deal. So we're telling that to our sellers. We're looking at a couple of different, certainly conditional earnouts, VTBs, sometimes just a reduced purchase price altogether. But what we've been successful at recently is we've been doing something, we call it a 2-stage buyout strategy, looking at coming in, buying 80%, 70%, whatever deal whatever number we can get agreed to, and then keeping the seller engaged. That helps close the gap financially, also mitigates the risk from an operational standpoint, shares the risk of what the future is going to look like. So, these kind of are the same thing, but the buyer's concerns are certainly the financial concerns. So deferred payouts are going to be more and more important. Earnouts are more and more important. Vendor take back notes, still cheaper than bank debt most of the time. So that's a way to get to improve the ROI if you can get your vendor to take larger VTB back. I did speak to somebody from EDC. I'll just mention it briefly here, but they've got a program that may be able to if there's any export at all involved, that they can actually guarantee the payment to the seller. And there's some terms to qualify, but it helps get that seller's head around, okay, if I'm leaving 50% of my buyout, as a VTB, I might be a little more open to it if I'm comfortable I'm going to get it back. So, and then, alternate banking, those are going to be options that we explore more. And I think we keep coming back to purchase prices are probably coming down. Next slide. This is just an example. It kind of pulls all the things that we're saying together. I think we've been maybe kind of maybe a little ahead of the curve, but because we're dealing with smaller size businesses, the risk has always been higher. So we've been doing this for a few years already. The risk is higher, or at least the buyers feel the risk is higher because of the owner dependency, because they're a bit smaller, they're not as independent. So we've been starting to do this two-stage sale process successfully for a while, and what it's doing is certainly getting buyers engaged, but also getting better multiples as well. So this specific example was a deal, it was it was a lovely little deal, $1 million in EBITDA a year, had tried to sell for a number of years, had a deal that fell apart, then found me, and I said, okay, well, we'll try it again. And, did an independent valuation, and we only came up with 3.4 multiple. And the seller was fine with that, actually, if we could have got them out. Went to market, had quite a few buyers look at it, and they all backed away. Every one of them backed away, said too much, key man dependency, and then the whole COVID and uncertainty and all that. So we pulled it back and then repositioned it where they would sell 80% and stay in for 20. And then we got 2 competing offers very quickly, and a better multiple came in at 4 times EBITDA. And we actually closed, even with a whole lot of complications coming up because the whole COVID, there was bank challenges. We had to renegotiate, I think, 3 times in the middle of the due diligence to keep changing what the bank was going to give them and that. So even in this space, we were able to close this deal. They got 60% cash pretty much up front. They're pretty happy with that. They're actually really happy. But on the ego side, they're going, well, I can still make another, 40% based on common shares and the equity I'm holding. And, we did a bunch of things to sweeten it just to make everybody happy, which was like a really nice salary with a great bonus structure. And that got us over the finish line, which, we all thought was a good accomplishment. And I spoke to them recently, and everybody's happy. Like, everybody's happy. In this case, there was an owner and husband and wife team. Wife got out in 3 months, thrilled, just thrilled. And the husband actually wanted to continue working in the business. He just wanted to do the stuff he liked doing. He liked dealing with the clients. He liked the actual operational side of the business. He just didn't want to do the management and the HR and the financials and all that. So everyone's happy. And it's a perfect kind of strategy in an environment like this where there's so much uncertainty. So anyhow, that's everything from us. And I'm sure there might be a couple questions.
There's one question.
Okay.
I can just use this.
Oh, I could do it here. Oh, do you see more down on tech company valuation as well? Yeah, I mean, we're not spending a ton of time in the tech industry. Oh, sorry. So the question is, do you see more downward pressure on tech company valuations in the next 12 months compared to others? So we're not spending a lot of time in that space, tech space. I would go honestly just to a tech buyer and find out what they're saying, and I would say yes, because I would say all of them are coming down, but we're typically looking at mature businesses versus startups, so that's the space we're in. And that's it for questions. Okay.
April,
Yeah.
question for you. So you're saying there's a bigger valuation gap between buyers and sellers. Is that driven by multiple or the buyer and seller's view of sustainable earnings?
Yeah, it's sustainable earnings, but I think everybody's been discounting, 2 years of shutdowns.
Yeah.
So a lot of the sellers are thinking they can get back to that point, like
Yeah.
COVID's over, so I can get back to the valuations I was expecting a couple of years ago. But because there's a whole suite of new challenges coming down the pipe, that's where I would say the gap is coming.
Are you seeing a lot of businesses where their earnings have been inflated from basically since the pandemic? So they've doubled or tripled? And
Yeah, that's happening too. So yeah, so certainly essential services never really shut down. Oh, sorry. Are we seeing companies that did very well through the lockdowns and
what's the gap?
And what's the gap there now as well? So yeah, every industry is going to be different for sure. I mean, there were some industries like wood, wood prices, tripled, quadrupled or something like that. Everybody's home beautification projects, they all went through the roof. How many people need a new pool? Like, if there was pent up demand, then it's probably been satisfied by now. So we have to reevaluate industry expectations and again, I actually have a pool company, and I can't necessarily use the last couple years like that we're selling, because they were exceptional years. So we have to kind of discount it, or instead of, I just take the multiple down a bit. Probably it's, but 2 years ago, everybody wanted a pool, and the future looked brilliant. Now, I don't think quite so much, because they want to put food on the table now, right? So it's a different story.
Yeah, thank you.
Yeah, for sure. Anything else? Oh, what is your fee structure? The question is, what is your fee structure? So we usually do, we always do an upfront assessment, and it really does depend on the complexity of the business. It might be 5,000, it might be 10,000. It depends on the size and the complexity. And then what we do, because we're playing, we're staying in for a longer term than a brokerage firm or anything like that. So we'll come up with a success fee, but we get paid a monthly fee throughout the time we're working with them, which is kind of an advance on the success fee. And they're not typically huge, but it's enough that everyone's committed to the process. My experience is working for a broker is I had deals literally fall apart 2 weeks before closing, and the sellers had no skin in the game at that point. But I had 600 or 700 hours of my time. So we're not doing that anymore. And the thing is, I think, truthfully, everyone pays more attention if there's a fee attached to it. Yeah. Nothing else? Oh.
So we'll just keep the Q&A open for a few more minutes, just to see if there's any further questions. If you would like to, again, the way you can participate is through the chat, through the Q&A, or by raising your hand, and Lorraine will turn your mic on if you want to speak as well. And for those in the room, obviously, if you have any other continued questions, please ask, and then we'll do our best to repeat every question that's asked, so that for those that are online, they can get wind of the question before we provide an answer. So again, we'll just leave it open for a few more minutes. I'll ask a quick question, and maybe if we get any questions after that. In the example you provided, you said that you guys faced some challenges through the close or through the financing process. Is there anything you can share as to the types of, were they COVID specific? Were they, just anything you could share on some of the challenges and how you guys got through those?
Sure. Okay. So yeah, on the example that I was sharing, the challenges during due diligence, they came out of all over, really, truthfully. And a big part of it was financing driven, for sure. So, the buyer was a private equity group. He was doing a roll up. He wasn't getting the financing that he wanted, that they were expecting. So he came back and said, well, the bank's only valuating at 3.5, not 4 times. And that's driving down the financing I can get. So he wanted to bring the purchase price down. It wasn't just financing anymore. It was now, we've overvalued it. But we were able to get through it. This is where the creative, extra little bonus every year was, throw $100,000 on, every year for a few years, as long as you stay with the company, kind of got through the hump there, closed the gap on that. And then certainly, understanding the industry and the dynamics of the industry, this, was kind of construction related, what was going on with the industry. There was at that point some uncertainty, and even now, this closed a while ago, but even now the climate is different. So the buyers may have had a different view on that. But overall, I mean, the biggest issue was truly the key man dependency, because he was an expert in this area, and his relationships, it was paper. There were no assets. It was just a staffing company with specialized expertise, and getting the owner to stay was very, very critical. And I mean, there were very tough negotiations around that, because we had to work through roles. So what's my role? I don't want to work 80 hours a week anymore. I only want to work 40 or maybe 30, and I actually want holidays. So there was a whole lot of things that had to be worked out. So it wasn't just financial stuff anymore. There was a whole lot of that. There was a point in time for 3 weeks that they did not speak to each other. They only called me screaming. I was exhausted. I took the summer off after, because they were literally could not talk because the conflict was so high. And that is starting, I'm seeing more and more of that kind of thing. But ultimately, everybody still wanted to get to the end. So if you have people that are willing to try to find solutions, usually we can find some kind of solutions. Right?
People are starting to see that as a starting point in your conversations with new sell side mandates. So as a senior or junior debt provider, getting through that transitionary risk for the smaller and the mid-market is critical, right? Many of these businesses are the individuals who founded the business, and going into this in a frothy market, we did see transactions happen where the keys were just handed over to the buyer. But going into this next phase of the market that has a lot of uncertainty, I think that transitionary risk is going to be something important for a lender to kind of wrap their head around. So how are you approaching that conversation?
So just to repeat the question, just it is, and I'll try to abbreviate it, but just are we seeing the transitionary risk becoming more important at this stage, in the market we're in today? And I would say definitely, definitely. And I'm literally introducing that almost day one when I start talking to like new sellers, in that this is what your multiple would be, all cash, or it might be lower, like this, basically, because the risk here is about transferring the client relationships and the knowledge to the new owners. And often it's at least a year, but often a lot more now. I would say it's probably 2 or 3 years most of the time, unless it's a pure roll up and they've already gotten industry knowledge and an infrastructure in place. For sure.
To your point earlier about the EBITDA discrepancies that you were facing through the financing process. Have you guys seen that a lot in would you say majority of the transactions? Do you see some of the times, and what do you anticipate going forward? So the question is the EBITDA challenges and the discounting, and I would say it's literally all over the map. And again, this is in that the assumptions I'm making are my assumptions, and the buyer could be making different assumptions, right? So I've got another little deal going right now, and the buyer, there's a couple people looking at it already, and the one buyer is going, well, yeah, we're gonna look at 3 years historical EBITDA, and I'm going, no. And he's going, what do you mean? And I go, well, they didn't do well 2 years ago because of this and this. So we're going to talk about this year and projections. And he's like, what do you mean? And I go, well, that's an assumption that we can defend. So it's not just, your traditional methodologies anymore. I think we look at the entire circumstance, the industry, what the future expectations are. And I'm hearing that from even some of the larger M&A shops, that they're just throwing the last 2 COVID years out the window and starting with 2022 and what's 2023 going to look like, and can I verify 70 or 80% of what's going to happen next year? So it's not always a 3-year trailing average anymore as your EBITDA, but that's a negotiation in itself, right? And that we're definitely having to do that all the time. We're finding that a lot too, just working around with that.
It's not clear. Like it used to be clear. It was always 3-year trailing average EBITDA, and now it's whatever we can defend successfully.
But the other thing that's driving that is the normalizations.
Yes.
So as long as our even is normalizations by a lot. And everybody has a different opinion, and they'll take your 3-year average EBITDA and normalize it to what they want it to be, because all they did was normalize it back up to, or push it down to a lower number. So you're finding that the multiple is just as important as the normalizations now. And 3 or 4 years ago, remember, there was almost no normalization. There was no COVID normalization. There was no normalization for salary increases around gas or shipping. What you mentioned, there was none of that. There was like 2 or 3 normalizations. Now you get the sheet and there's 15 normalizations. And you're sitting there going, holy Christ. And everybody's got a story for every one of them, and you gotta try and figure out which one you live with and one you won't. So the normalizations are actually a much longer discussion. Everybody keeps talking about the multiples, but the normalizations are
More
are
important.
more important probably than the multiples.
Yeah, and whether it's all cash or it's deferred is more important too. So, in the example that I was sharing is, the 3.4 was an all cash deal, right? And then when we said keep 20%, then it became up to 4. But then ultimately that 20, if everything happens and the growth strategy actually materializes, then they might end up with 5 because the expectation is that it's going to do very well in the future. So it's moving, like everything's moving now, and you just have to be fluid to the changing dynamics for sure.
I have a question.
Yep.
What role do you see mezzanine debt playing in the market moving forward?
Yeah, so I mean, we typically are looking more like at the BTB side and kind of that, like the seller keeping equity or quiet equity. I think that some of the bigger deals, it's going to make a lot more sense to be looking at that. And certainly, the banks, like, we're seeing, you're going to have Schedule A, you're going to have some secondary debt, you might have alt, and you might have the seller, like you might have multiple sources of financing in all your deals going forward now.
I think the other comment there is that in a bigger deal, there's a lot of people looking to put out $2 or $3 million in sub debt. In a little deal where you're looking at somebody to put $500,000 in sub
Yeah,
debt,
it's too much
there's
work.
almost no non-existent.
Yeah.
So you're also dealing with that way. The other thing is that people kind of forgot about sub debt. They replaced it all with a vendor note. So the sub debt guys are trying to fight their way back in. The Royal Bank guy a couple of days ago was pretty lonely at his table looking for sub debt deals. Because people always say, no, the vendor note took that position. And if you look at the senior debt side, if I'm lending as a senior debt lender, I'd much rather have a vendor note than sub debt. Because sub debt's got a big coupon on it, and they usually got some hammers in there. And they're structurally subordinated and postponing it, but they got some teeth. The vendor note usually has no teeth. Or very
And it's
little.
cheaper. It's a lot cheaper.
Yeah. So they'll try, and there probably will be some places where it fits. I think it would be fit the best when there was high EBITDA percentages. So there's lots of cash flow coming in, and you can service the senior and a slice of sub, and still lots of room. Then the senior debt will let it be in the capital structure.
Yeah. I'll go through. There's a couple questions. Will this deck be sent to participants? I believe so. Yeah. So
There's
that's
a fee of $10,000 per copy.
what size companies do you work with on the sell side? We typically don't go much below 500,000 in EBITDA. And we do a lot of advisory work. So we're, like I call it, like stage 1, stage 2. We're doing a lot of advisory work, long as we're getting paid for our time. And like I said, we have an accordion kind of approach to small business. I do a lot of pro bono work. I'll spend an hour on the phone with small kind of lifestyle type businesses, just educating them on what to expect, because most of the time they're not going to be able to take it to market and sell it anyway. So I like them to know that instead of wasting years trying to take it to market, and giving them some options. So we do the advisory work, the stage 1 for anybody, and give them a good insight onto market dynamics and what we've just shared with you, that kind of stuff. But going to market, typically we're like everybody else. We're tapped into private equity groups, financial buyers. We have a big network between us. I was kind of impressed. I sent out just a little deal a couple nights ago. I sent a blast out, and I had a buyer calling me like 12 hours later. So and it wasn't on my mailing list. Somebody took it and flipped it to him, and I was like, wow, that worked. So clearly, this stuff moves. There's still people looking for good opportunities, but they've got to manage the risks involved. In your example, where the buyer had to renegotiate the price based on lending requirements, where in the M&A process do you usually see this happening prior to executing the share purchase agreement? Yes, definitely prior to the share purchase, because you're kind of stuck then. In this case, the buyer did, I would say, drag the due diligence a little bit, but to his credit, he needed to understand it better. So it took a long time. It took almost 6 months to do the due diligence. So that was way more than anybody wanted. But he did understand the company really, really well when he got to the end of it, and was able to kind of kickstart it very quickly once he took over. And yeah, so this did happen between the LOI in the middle of due diligence. And it kind of wasn't expected, but we were all just getting a feel for what was happening at the banking stage as far as discounting all the COVID subsidies and really trying to understand, well, we would have laid 30 people off basically if we knew you weren't going to count the subsidies, right? So we had to find a way to get through that issue, and it was challenging, definitely. I think that's it now. Okay. Thank you very much for your time. And if you have any questions, we'll be here for a bit.
Thanks, April and Ross. Great presentation. Obviously, lots of great discussion. A couple of quick points before we close. For those that did get a chance to attend the Ontario Gala, great success, great networking. Nominations for next year's gala are going to be opening soon. So if you have transactions that you feel like you'd like to nominate, it was kind of like the Oscars for M&A transactions. So pretty cool. You got some people up there with big trophies and lots of cheering in the crowd. So it's lots of fun. So definitely recommend to do that. Regarding the Mississauga Club chapter, like I mentioned earlier, we'll, this is our last one for this year, and we'll kickstart back in January. Information and dates to follow on upcoming meetings for January onwards. We typically will be holding them, as I said, as a breakfast on typically the third Thursday of the month. Right now, with the exception of January, maybe being a week later. But so just keep that in mind if you're looking to attend. And other than that, thank you again for a great year. Thanks for the M&A Club for working with us as support, and thanks for Loopstra for hosting, and giving us a great venue to have our get-togethers. And yeah, maybe I'll be the first one to say this, but happy holidays and and wish everyone a great rest of the year. For the folks in the room, don't leave. We're going to do a bit of a round table, and then everyone else, we'll see you in the new year. And thanks so much.